Welcome to this continuing series of videos from the Practice Protection Committee. We are very pleased today to welcome back Dr. Mark Aeder for today's topic of the biggest financial mistakes surgeons make. Thanks for being with us, Mark.
Thanks again for having me back, Patrick.
So Mark, I'm going to assume that probably the biggest mistake that surgeons make is not saving enough. And we've talked about in some of our other Practice Protection Committee materials about pay yourself first. So let's start off by talking a little bit about savings. And is it more of an issue of people don't save enough, or they don't save at all, or they don't put it in the right places?
The answer to that is yes. So I think the biggest thing that really hits you is when you first get out into a position. It's really exciting. All of a sudden, you're taking a look at a paycheck the size you've never seen before. And it's really tough to put away a lot of that money. I mean, we have to get into a little bit of the delayed gratification mode if we can. We'll touch on that a little bit later. But we have multiple savings opportunities. And there are ones that sometimes confuse you when you first come out, the retirement accounts. Depending upon whether you're with a for-profit or a not-for-profit, you're going to have a 403B or a 401k. And you can really maximize that out fairly straightforwardly from your paycheck. Money goes right into your account. I think it's $19,500 each year in 2020, and it's taken out each pay period. And that's kind of protected money. Then you have to do something active. You should have an IRA. You may have had an IRA for years, but go ahead and continue to fund it. You may not qualify for what we call a Roth IRA, but you can still have a conventional IRA. That's another way to park away another $6,000 a year. What we want to do is we want to save at least, at the minimum, 15% of our gross income each year. So 15% before taxes, before any deductions, should really come out. And not only do we need to save it, but we need to invest it. If we just save that $19,500 and that $6,000 a year, we're not anywhere near that 15%. So now you really should find an account that's not your checking account and start putting away money into that account. And what you can do is you can invest your qualified savings, or your, if you will, your retirement savings, your tax deferred savings, but also create your own savings account going forward. We've got to put that money away. Otherwise, it's not going to be available for us when we need it.
I would assume that this is especially important earlier in your career. Otherwise, you find yourself in a catch-up situation.
Exactly. As we talked about before, the total amount of money you're going to have is going to depend upon how much you invest, times the length of time you have before you need it, times the risk of what you're willing to take on those investments. Time is the one thing you can't adjust. You've got a limited amount of time. At some point, you're going to need to tap into that money. And when you do, excuse me, when you do, that's going to be your time limit. So the earlier you start, the better it's going to be. Now, one other thing I just want to get into is that when you're first starting out, you say, oh, well, I need to save for retirement, and I put it in my retirement account. And then I need to save for college or something, or for your kids or whatever. And I'm going to try to change that a little bit in your mind by just having you think about, if you save it in your own savings account rather than a particular college account, you can put a minimal amount in there, but save it in your own savings account and then see how you get through and all. Always remember that for a child going to college, you can always get a college loan. But if you're hitting retirement, you don't get a retirement loan. No bank's going to write you a retirement loan like they'll write you a college loan for an education. So remember to try to keep that money separate. It's a good thing to have. It's a good thing to think about. But if you can have that flexibility and move those funds back and forth.
So are there additional savings vehicles, Mark, that people should think about, like, for example, a health savings account or other pre-tax savings opportunities?
There are. There are definitely some other accounts. There's 457s. There's different accounts depending upon who your employer is and what they've been able to do. Healthcare savings accounts, if you have a high deductible healthcare insurance, you can put up to, I think it's $3,550 an individual, $7,100 a couple away each year into that. That's used to pay your deductibles or pay your uncovered medical expenses. But if you don't use it in a particular year, it keeps rolling over, and it rolls over on a tax-deferred basis. And eventually, once you reach a certain age, that money comes to you pretty much for most any use, just like your IRA would be. So you do have those other opportunities for savings on a tax-deferred basis as well. So I think you should explore this. This is where your financial advisor is important, where your accountant is important. And you just kind of put all these vehicles together. But try to hit that 15% mark at least every year. If you can hit 20%, that's good. If you're age 50 or older, you can put more into your 403B, 401k, or IRA, or even your HSA. You get a catch-up bonus. Look to maximize that, because that money is going to be worth a lot more when you're ready to retire.
So it's intuitive that if savings is the biggest mistake, that maybe the second biggest mistake comes along the lines of debt and debt service. So what general advice do you have, starting off maybe for the young surgeon, about delayed gratification? I mean, we know that it's very difficult for surgeons who train so long, and it may be the first time that they have expendable income, but what sort of tips do we have for them?
So there's good debt and there's bad debt. So what do I mean by that? Good debt is money that you get at a fairly low interest rate. Right now, mortgage rates are 3% or less. That's pretty good debt. If you take on that, I would not be too anxious to pay off a mortgage if I had it at 3%, because chances are your investments should be making more for you than 3% a year, even after taxes, plus your mortgage is a tax deduction, on top of everything else. So that's good debt. Bad debt, credit card debt, over 20%. We have some loan debt that we may have. Some of the student loan debt can be in excess of 7%. That's kind of bad debt. We need to get rid of that bad debt as rapidly as possible. So here's where you have to go ahead and balance. You have to have a structured program of getting out of debt. We know that the average resident hits practice with over $150,000 worth of debt. That's huge. But it doesn't all have to be paid back at once. It can be stratified. You pay off the highest interest rates ones on a more accelerated pace. And then finally, you get to the lower interest rate debt that you can carry a little bit longer. What you need to do, though, is you need to balance. You can pay off your debt, but you have to put money away for savings. I can tell you, I had one story where a young physician told me, or actually it was a mid-career physician, said, I finally paid off my debt, and now I can start savings. And they've already missed the first 12 years of their practice addressing their debt and their lifestyle and not putting away anything for savings. So the biggest key here is that you have to pay off debt. You also have to save. If you put away that 15% off the top so you don't even see it, you'll be able to work your debt into your budget, and you'll find out what you're able to afford. I always say with credit card debt or something like that, if you can't afford to pay it off at the end of the month, you can't afford to buy it. And you should really try to pay off your credit cards every month. Other things, home, cars, yeah, I mean, we're going to pay those off over time. But in terms of your day-to-day operations, try not to run up credit card debt or try to run up bad debt. Try to instead delay some gratification there, modify your budget, and be able to live within your means. So not all debt is bad. Try to avoid debt. If you're getting closer to retirement, certainly don't take on any big debt obligations. You don't want to be going into retirement with a whole bunch of loans out there. And the other thing you don't want to do and is if you have a child who's going to school and they're taking out a loan, you don't want to co-sign that loan. Do not co-sign any debt on the loans because that may end up being your debt and it may have a huge impact on how you're going to enjoy your retirement years.
So I think you touched on a little bit on this, Mark, but let's talk specifically about, how does debt service vary for someone who's 60 versus someone who's 40? Maybe someone who's all their kids are in college versus someone who has children who are still in grade school. Is there a different strategy there that they should focus on in terms of their debt service?
I think you just have to be really smart about this. You're going to come out of your education with a lot of large debt. You're going to want to try to whittle that down before you take on anything else. I always say that you're used to living small. That's how you got through school. That's how you got through training. You weren't really out living a high life. And so the adjustment of doing that for your first number of years in practice, I don't think is going to be that much of a change. You're not going to be missing anything. You're going to be adding it on as you go along. Again, as you get further along, you'll have more, you'll accumulate more, you'll have more obligations. But then you're going to reach a point in your life where you're going to say, you know what? I think we're going to start winding some of this stuff down. What's important? What's not important? And you're going to be really wise about any kind of new debt you want to take on then. Sure, there's a lot of relaxation. There's trips. There's a new boat or there's a vacation home or all these sorts of things. But you have to be wise about it, about what you want to strap yourself down to so that you're able to meet all your obligations and not have to worry about how long you're going to have to work. You can still retire or transition careers on your own schedule.
So in our two previous videos, Mark, we really focused on, having a team of financial experts to help you and to pick that financial advisor. And the take-home message that I took away from that is that you've got to have a plan, and that you make a big mistake when you don't keep track of where you are right now.
Yeah. So I think everybody should have a strategy. As I said when we talked about financial planning, everybody's unique. You, your spouse, and your partner, you're going to come in and you're going to have your own needs. You have your own obligations, your own goals, your own dreams. That's totally unique. You need a strategy and you need to be able to work it out in order to be able to get there. You need to pay attention to what you're doing. There are so many distractions. Practice in and of itself is a huge distraction. Family life, a distraction. All sorts of personal obligations are distractions, but you can't be distracted on how your financial accounts are doing. You have to check them. You have to see if your strategy is still working. Are you still on the right path in order to be able to achieve your goals? You should have a professional advisor there who's meeting with you and being able to walk you through a lot of these things as we go along. But you need that strategy. You need your eyes on it. This is your life. You've really got to take care that you're totally focused on this.
In our previous video, we did emphasize that having to have an expert and that you can't afford to not do this. And it's almost like this is an insurance policy in and of itself. It sounds like it's expensive, but really in the end, when you balance it out, you literally cannot afford to not have a plan and not have people help you execute that plan.
So every dollar you're putting away, Patrick, it has to be maximized. You need the maximum return on this. This is not something that I think you can do in your spare time. The markets are much more complex. I can tell you back even before I started, there were interest rates that were well into the double digits. So if you bought bonds, it was very easy to increase your worth by double digits each year, 12, 13, 14%. Well, bonds are not paying that right now. They may be paying 2% or 3% or something. You're not going to be able to retire on those sorts of investments. It really takes a good strategy. It really takes something that's really honed in and, for my opinion, a fairly aggressive strategy from some wise people sitting there with you in order to be able to get you really where you want to go. But how expensive is it? I think we talked about the ways you reimburse your financial advisor, for instance. And I think the key is let's say one day you're fortunate enough you have a $2 million home or you have a $1 million home. All right. Think about $1 million home. What are your property taxes on that home going to run? Well, chances are they're probably going to run you anywhere from about $20,000 to $30,000 a year, even if you're not in a high tax state. Add in the property taxes and your insurance just to have the home. Now, think you have a $1 million or a $2 million account and you're paying 1% of that for the management each year. That's $10,000. And if you're earning more than that 1% back because somebody's watching that for you, I think that's a bonus. So we don't think much about how we protect our home or how we pay the taxes on our homes or on our everyday dealings. And I don't think we should really shortchange on what we're paying for that kind of advice. Because again, I can't emphasize it enough, is that your strategy is going to change, your needs are going to change. And as you go from one stage to another, I don't want you to leave any money on the table. You work real hard for that. You've spent a lot of time getting to be where you are. You should be able to maximize the returns.
So Mark, let's talk a little bit about insurance. I know when I was coming out of residency, as I'm sure most of the young surgeons are now that they get approached by insurance agents and try to sell them various types of insurance products. And obviously your insurance needs change also as you get older. So what sort of insurance, how do you plan for the insurance needs for you and those of your family?
Well, the one good thing about insurance is that you can really buy it, and once you buy it, it's yours and you have it. So the first thing is that when you get insurance, get it when you're healthy. Get it before you have anything that happens that can in any way complicate your health care, make you either a poorer risk for insurer or maybe even a non-risk. And so if you get it early, then if you have a problem, you're insured. Once insured, always insured. So I talk about a number of types of insurance that you really need and you should not scrimp on. One is life insurance. And so your life insurance is going to carry with you probably the most effective way to get one, a policy, is a term policy. And you should have it for at least 5 times and preferably up to almost 10 times your annual gross income. And maintain that. You may be able to get rid of it in the later years as you develop more capital in your accounts, but I think that's going to protect you. It's going to protect your family. Term insurance, I think, is more than adequate. The important one is disability insurance. And most people look at disability insurance and say, well, I get disability insurance through the hospital, or I'm on their plan. Well, is that going to carry with you once you leave? If you leave that job and you go to another job, you're not carrying that disability policy with you. You have to get a new one. And if you're not in the same health, you may have to pay a higher premium or you may not be insurable at all. So get your own disability policy, carry it with you throughout your life, throughout your career. Get it from a reliable insurance company, one that you know is good, is going to be around for many years. And I find the best way to do this is through an insurance broker who does nothing but disability products. I think they'll steer you in the right direction. The disability products have changed markedly since you and I finished medical school and or finished residency, but there are still things to look for, and I think that's where you go with the broker. Buy it, keep it in your own, pay for it with after-tax dollars. If you are ever disabled and you can't work, you're going to be more expensive for your family to take care of. You're going to be more costly than if you've just passed away. It's a real challenge. And when you look at the statistics, at age 35, there's almost a 40% chance that that 35-year-old is going to have a disability of 6 months or longer at some time in their working career. So before age 65. And it's not what you think. It's not just trauma or anything like that. About 90% of the disability claims are due to illnesses, neuromuscular illnesses, infectious problems, cardiovascular problems. There are all sorts of things that can happen, malignancies, that put us out of work or do not let us return to the work that we've done for years. Get a disability product, pay for it, and really treat it like your mortgage. Even if times are tough, that mortgage payment has to be paid, that disability payment has to be paid. So those are the two main ones. There's another policy that I talk about called umbrella policy. And an umbrella policy is a personal liability policy that exceeds your homeowner's policy or your renter's policy and your automobile policy. So that sometimes that's only covered to say $200,000. Well, if you're ever sued and there's a judgment against you or your child is driving your car or something like that, you can imagine what could happen. They see there's a dock behind there, and so somebody's going to sue you for a lot of money, far more than the limits of your basic homeowners or automobile insurance. Buy an umbrella policy. Get one for at least $3 million. You can get a $3 million or $5 million. It's not that expensive. It's a few $100s a year, I think, per million. You may never need it, but again, it's that little extra protection that can certainly go a long ways to protecting your nest egg. So you just don't want that to ever happen to you. So always remember too that your retirement accounts are always out of any sort of legal settlement. So you don't have to worry about your retirement accounts being touched with that, but you have a lot of other assets that could be. So the umbrella is important for that.
So finally, let's spend a little bit of time talking about life's disruptive events. And, we're all going through the events imposed by the pandemic right now. And in our previous Practice Protection Committee materials, we've emphasized that whether it's a pandemic or whether it's a change in your marital status or a job loss or medical issues, a family financial crisis, whatever, that we really need to not react emotionally and that we need to be prepared for the next crisis, even if we weren't prepared for this one. So let's spend a few minutes talking about that. What do you think is most important with regards to the preparing for disruptive life events?
I think the best thing is to have some sort of backup plan in your mind. I mean, some of these are avoidable events or potentially avoidable. Some of these are not avoidable. I mean, keeping attention, for instance, on your financial accounts and making sure they're not being mismanaged or that you're not having any difficulties with that. I mean, that's potentially avoidable. Some of the other external pressures you get with your job, You've just got to be aware of what's the changing situation in your environment. Where's the competition? Where are the insurance contracts going? How's your relationship with your partners? How's your relationship with the rest of the department in the hospital? These sorts of things, I think you really have to try to really pay attention to a lot of the cues about where we go on those. When you look at these life-altering, disruptive events or what's really going to happen here, some of them are really avoidable in some extent, to some extent, by you just keeping attention to the situation. For instance, not running out of money because you didn't watch your financial situation, or keeping an eye on how much your retirement accounts are growing and making sure your financial advisor is working the right way. Some of them are potentially avoidable by seeing them coming. You can see changes in referral patterns, insurance plans, how you're getting along with the different hospitals, or how your group's doing, or how your partners are, or how the hospital's doing. And you can kind of get a feel for how to almost mitigate a lot of those things. Some of them really are unavoidable. I mean, personal difficulties at home. I mean, it may be personal difficulties in your marriage. It may be personal difficulties with your children. It may be that they moved back home, they've lost their job. All of a sudden, it's a completely different situation. And then, of course, there's illnesses. I mean, developing a chronic illness or developing a malignancy that has to be addressed can certainly be life-altering. So you don't see those coming. Some of the other ones, all of a sudden, we get a change in political structure, and taxes all of a sudden that you hadn't expected to pay now have to hit you. You've got to be really prepared for this. We never were prepared for a pandemic. We never were prepared for all of our elective surgery to be shut down. We are always used to a paycheck. Think about it. We've gone through residency. We got a paycheck during residency. We came out, we got a guarantee for 2 or 3 years. We now have performance. We still get a regular paycheck in practice and all. And now all of a sudden, for the first time, we're not collecting a paycheck. And what you don't want to do here is you don't want to be emotional about this. You can't panic. When emotion enters the room here, I mean, the first thing to leave is reason. And you need to be very reasonable about being able to adjust yourself and adjust your family to kind of weather some of these disruptive events. The budget is very important. Take a look at your budget. Take a look at what things are really important. I'll give you a beautiful example is that, the gyms have been closed, or the yoga studios have been closed for about the last 4 or 5 months. Why should I be paying a membership for the last 4 or 5 months when there's no chance that I can even use that membership? You think about your country club, you think about your dining clubs, you think about all the other things that have been going on. And yes, I know this is kind of temporary, and I hope the loss to your income is going to be temporary, but you've got to balance these sorts of things. You've got to plan in some way for these unexpected events. You have to sit down with your partner and spouse and children if necessary and decide. You decide the university, for instance, next year is going to remote learning. Is this the time to pay full tuition to a nice private school for a full semester of remote learning? Or is this the time to say that, maybe the gap year is not such a bad idea or something like that? There's ways of mitigating some of these sorts of things, but don't react emotionally. I mean, don't go out and say, well, I'll do anything or everything. It's going to be okay. You're an MD, you're a surgeon, you've got these skills. Sure, you can do other things within the community. You're certainly trained in critical care. You're certainly trained in emergency care. Mm-hmm. There's a lot of other opportunities out there for us, but just don't be emotional. You need a reserve.
Yeah, so that's what I was going to say. Speaking of the reserves, I mean, I think that one of the best ways to preclude yourself from becoming emotional is to have a good cash reserve on hand. And we've talked about previously that you need to have a minimum of 6 months operating expenses based on your budget. We would refer people back to the economic survival strategies exercise that the Practice Protection Committee put out several weeks ago, that's still available to them. And exactly how much, Mark, do we think that we need to have as a minimum in those sorts of accounts?
Well, I think, if you operate your home as a business, which in a lot of regards it is, you have cash flow in, you have expenses, you really do need a 6-month reserve. You have to be able to survive 6 months on basically no income. And I'm not talking about tapping into your retirement accounts. That's the last thing you really want to do, because once you take the money out of there, and I know there's some leniency on that right now and it's very tempting, but you're missing out on opportunities for further growth. So please, try to avoid that. But if you have a 6-month reserve built up, you adjust your budget to that 6-month reserve, then I think you're going to be able to weather this, because the whole landscape, the landscape was different 6 months ago. It's probably going to be different 6 months from now. Remember, we're not a restaurant. I mean, we haven't lost the patrons and the opportunity, for one particular night, or we're not, the barber who when they miss a haircut has always missed the haircut. Patients are still going to need the same surgeries that they needed before this hit, before we had to shut down elective surgeries and everything. They're going to still need the follow-up. They're still going to need the care. They're still going to need the interventions. I almost see a huge backlog of surgeries that are going to have to happen. And it's going to take us quite a while to work our way through the queue in order to be able to get a lot of these surgeries done. So this is not the time. Again, don't panic. All right. Don't get emotional about this. You build up a reserve. This is what we talked about in terms of saving. You have your retirement saving, but then you're putting that other money away. Remember, up to about 15%. This is building, if you will, your rainy day fund. This is what you're going to tap into. This is your liquid asset that you can now bring to the table. You'll be through this. You'll be back to where you're supposed to be, or where you were. The patients are going to come back. They're going to need it. We've got to build up some sort of financial resilience through that. We can talk about that at, even at another time if you want, but we can't be rash. I mean, that's not going to be productive. We've got to be smart. I mean, again, I think we used this analogy in one of our webinars, Patrick, is that when you're faced with a tough situation, you think about it as an acute trauma. You get in there and you just kind of pack everything off, and you kind of stem the bleeding and just kind of then relax, take a deep breath, and start to formulate the plan in your mind on how you're going to approach what's going on in front of you on the operating table. Same sort of thing that we do every day is we start to take that approach. This is a disruptive event, and it didn't have to be the pandemic. It could be an illness. It could be a huge financial challenge that you get hit with in your practice. It can be anything, but it's going to be, you're going to get to the other side of this at this point. What you need to do is you need to kind of approach it in a good concerted fashion. I have one quote that I use quite a bit, which is the unexpected happens, plan for it. And that's by Margaret Thatcher. And really, the best way to get through one of these unexpected or disruptive events is to really have a plan for it, and to really have some reserves and things to do that you can call on when you're in that situation.
So we would encourage everyone to begin those preparations now for those unexpected events that we do know are going to happen. And we also know that it's never too late to start. And as Mark has said, our goal is financial resilience. And that we hope that with attention to your savings, to your debt service, to your insurance, and attention to having a good financial team and a financial advisor, that you'll develop that adequate financial resilience to survive and succeed, regardless of the unexpected disruptive life events that may come our way. Mark, I want to thank you again for being with us today. Really appreciate your time. Really appreciate your encouragement.
Well, thanks, Patrick. It's always a pleasure to talk to you and see what we can do to help the fellows to start to think and organize around this. And these are very important issues.
Great. Well, we thank you for joining us today, and we encourage you to join us again for the next video interview from the Practice Protection Committee. Good day.